video continues from the previous one about liabilities, for the simple reason that I am driving a far distance today. So last week I spoke about liabilities, the week before about assets, and today I'm going to be talking of the difference between the two, which can also be considered equity. My name is Jacques Taljaard, this is Taljaard Accounting Services, and if you're new to my channel, you will find topics such as what's an asset, what's a liability, how much should you save for income tax, and all of this from a business point of view, especially in South Africa. Topics of accounting, tax, and general economics and business advice for businesses within the country. So today's topic is equity. Now, the financial, well, where do we start other than with coffee? Where do we start? We start with the definition. The International Financial Reporting Standards conceptual framework defines a number of items, such as an asset and liability. Now, these I've given to you last week. Equity is a somewhat different one. It's not really defined in the framework itself, rather it's defined in IFRS 9, a specific standard that deals with share-based payments, financial assets, and just equity in general. So an equity is a contract or contractual evidence of a residual interest in the assets of an entity after liabilities have been deducted. Now, this is a very interesting and often confusing topic, because the basic concept of owner's equity is that it's the residual interest of assets after liabilities have been deducted. In the accounting function, equity equals assets less liabilities, or assets equals liabilities plus equity. That is your basic balance sheet, and that is where your concept of equity is reported on. But the definition of the standard adds a contractual evidence. So how do you have contractual evidence of equity? Usually by means of a share certificate. Share certificate means you own a percentage of the equity, and if your share certificate is 100% of the distributed shares or issued shares, regardless of how many shares the company is authorized to issue, if your share certificate have 100% of the issued shares, you own 100% of the company. If your share certificate only have 10% of the shares, and my share certificate, for example, have 50%, and the other 40% shares is in a different share certificate that is owned by somebody else, then I own 50, you owe 40, or you owe 10, and this other person owes 40, right? So that's then your contractual evidence, right? The share certificate. Now, the share certificate have to be issued by someone specifically, and that is usually either the company secretary or the chairman of the board, or both. They usually offer the share certificates in a private company. Now, the exception to the rule is that when a company is listed on a public stock exchange, such as the Johannesburg Stock Exchange, the JSE, or the Guangxi, or the Nasdaq, or the FTSE, or any of these stock exchanges that you hear about in the news or in the financial news every day, quite often the entities in these that are listed here don't physically have share certificates for the equities that is listed on these stock exchanges, right? So, by the way, a share and a stock is pretty much the same thing. It's a term that is used interchangeably. Technically, there is a small difference, but for general purposes, if someone talks about stocks, they're usually speaking about shares. Stocks are usually just shares being traded on the stock exchange, right? So shares is, your share of the company. That's pretty much where it comes down to. And so stocks is just the certificate, the physical form thereof, the paper trail thereof. So IFRS 9, when speaking about financial assets or financial instruments, classifies a couple of items that are slightly different from shares. There's what they call ordinary shares, which is the shares that you usually hear about. But then there's also something they call preference shares. Now, a preference share means if dividends get paid out, the preference shares get dividends first and then the ordinary shares. Okay, now this doesn't happen very often. This is usually in share-based payments or specific reconstructing deals that preference shares are issued or defined, and they don't always get traded on stock exchanges. They are more often held privately or individually, based or as a result of a specific transaction, right? Now, it's important to note that not all ordinary shares are traded on stock exchanges. Not all shares are traded there. In a private company, the very essence of a private company means that the shares are not available to the public, where a stock exchange essentially means that the shares are available to the public. Any person can buy shares on the stock exchange. If you're using online banking, just have a chat with your bank and make use of their platform, and you have access to buying shares on the stock exchange directly. So that's the difference between a public and a private company, primarily, or a listed and a private company, is that the private company shares is generally limited to specific individuals. So those are the big items, or the two major classes of shares. You have preference shares and then you have ordinary shares. But companies usually add all kinds of limitations to the shares. I've heard of cases where shares are they don't participate, non-participating shares. They don't participate in votes of the company, or non-voting votes. So votes in a company usually means at the annual general meeting, every person that holds a voting right in the company, which is usually a share, gets to vote on certain matters, such as how much the executive director should be paid, how much their annual increases will be, who the external auditor will be, whether the company is going to be buying this other company or not. Those kinds of items are shareholders' resolutions, and they're usually passed through vote. And a shareholder that have voting rights usually votes on this. But I've heard of cases where shareholders own shares, but the shares are not associated with a voting right. So there's all of these items of shares that usually then mean voting rights, or is the contractual proof of your equity. Now, I want to mention that in South Africa, it is possible for a company, for a shareholder to be liable for company liabilities. Okay? Shareholders and directors are often held liable for company liabilities. But the director specifically, they have to be proved to be negligent, and that is very difficult to prove. And the shareholders usually have to make sure that the directors do not trade recklessly. Now, reckless trading means the company is trading in an insolvent capacity. In other words, the liabilities are more than the assets are, which means you have negative equity. Now, the Companies Act specifically prohibits this, but there is the exception to the rule. My example of a liability in last week's video, I mentioned that if a company starts up, the company cannot afford any finance, and no bank will give a startup company any money or any form of a loan. And as such, the company, they cannot acquire the assets that they need in order to start the productions, to start working. So what happens? The shareholder usually gives the company finance. And in those cases, right off the bat, the company has expenses, right? The company has liabilities and obligation. And the company quite often then do not have a lot of assets. Within 1 year, say 20% of those assets are depreciated. There's depreciation within 1 year. So the finance is not necessarily repaid, especially not in a member's loan. But the company still has that loan, but the company hasn't made that much money trading it, so the assets are still reduced. So in those cases, the company is technically insolvent, but the Companies Act do allow for cases such as that for the shareholder to certify that the loan will not be called up unless the company is liquid. And that is the exception to the rule, where a company can trade in a technically insolvent capacity. Now, this does not mean that the shareholder should become complacent in those cases. Negative equity is a bad thing and always will be. As far as possible, make sure that the company starts making profit as quickly as possible, so you can build your shares, because eventually your equity is what the company is worth at the end of the day. There are a lot of valuation techniques where you can calculate the value of the company, but in short, as of any given moment, the least minimum the company is worth is its equity, because that's what's left of the assets after the liabilities have been deducted. And as a result, then that's what the company is worth. So you want to increase your equity as much as possible. My name is Jacques Taljaard. This is Practitioner Accounting Services. This video was on equity. I hope you remember that. And I hope you have a fantastic weekend.